Friends, gold trading is one of the most popular trading markets in the world. But the truth is, out of all the people who enter gold trading to make money, a huge number of beginners end up blowing their accounts. And there's mainly one reason behind that: lack of knowledge. Most beginner traders simply place buy and sell trades without properly understanding the market. They don't know about lot size, risk management, or the major factors that move the gold market. But once you truly understand how the gold market works, gold can give you amazing opportunities and can even become your favorite asset to trade. So in today's video, we'll understand everything from the basics: what gold trading actually is, why gold moves so aggressively, what lot size, leverage, and pips mean in gold trading, how to manage risk properly, what the best trading time is, and at the end, we'll also discuss a simple gold trading strategy that you can practice. First of all, let's understand what gold trading actually is. In trading, gold is known as XAU/USD. Here, XAU means gold and USD means the US dollar. In simple words, we trade the price of gold against the dollar. Just like other financial markets, we analyze the chart and predict whether the gold price is likely to go up or down. If we believe the price will rise, we place a buy trade, and if we think the price will fall, we place a sell trade. For example, if gold is trading at $4,500 and you place a buy trade, and later the market moves to $4,510, you'll make a profit. But if the market goes down instead, you'll be in loss. Now, one of the biggest reasons why gold is so popular is because of its massive movement. Sometimes gold moves in a single day as much as some forex pairs move in an entire week. And that's exactly why traders love trading gold. But now the question is, why is gold so volatile? There are mainly three reasons behind it. The first reason is the US dollar. Gold and the US dollar usually have an opposite relationship. When the dollar becomes weak, gold tends to move bullish. And when the dollar becomes strong, gold often becomes weak. The second reason is news events, like NFP data, CPI reports, interest rate decisions, and Federal Reserve speeches. During these news events, gold experiences huge volatility. Sometimes gold can move 100 to 200 pips within just a few seconds. The third reason is fear and uncertainty. Whenever there's war, recession, or economic tension in the world, people shift their money into safer assets, and gold is considered a safe haven asset. That's why gold often shows very strong and fast movements during uncertain times. These were some basic things related to gold. But if we actually want to trade gold, then we must understand some important concepts like lot size, leverage, and pips. So let's first understand lot size. Basically, there are three types of lot sizes in gold trading: standard lot, which is 1, mini lot, which is 0.1, and micro lot, which is 0.01. In one standard lot, we trade 100 XAU USD. In a mini lot, we trade 10 XAU USD. And in a micro lot, we trade 1 XAU USD. Lot size should always be used very carefully in gold trading because gold moves extremely fast. If your lot size is too big and the market moves against you, your account can get damaged very quickly. That's why for beginners, micro lot is considered the safest option, where we trade only 1 XAU USD. Now currently, the price of XAU USD is approximately $4,500. So even if you trade with the smallest lot size, the micro lot, technically you would still need around $4,500 to trade it directly. But for beginners, that amount is obviously too high. So now the question is, can we trade gold with a smaller amount of money? And the answer is yes, absolutely. This is where leverage comes into play. Leverage is a tool that allows you to open bigger trades with a smaller amount of capital. For example, if you use 1 to 100 leverage, then you'll need 100 times less capital for the same trade. That means you can trade 1 micro lot of gold with only around $45. Different brokers provide different leverage options. Some brokers even offer leverage up to 1 to 1,000. That's why leverage looks very attractive to beginners. But remember, higher leverage can increase profits, but it can also increase losses equally fast. So leverage should always be used carefully and smartly. Now, after lot size and leverage comes another important concept: pips. Understanding pips is very important because gold price movement is measured in pips, and we also calculate our profit and loss through pips. The full form of pip is percentage in point. Let's understand this with an example. Whenever gold moves by $1, we consider that movement as 100 pips. For example, if gold moves from $4,506 to $4,507, that means the price moved up by $1, so we consider it a positive 100 pip move. Similarly, if gold moves from $4,506 to $4,505, then that's a negative 100 pip move. Now, to calculate profit or loss, we multiply these pips with our lot size. For example, if you're trading with a standard lot and the market moves 100 pips, then your profit or loss will be around $100. With a mini lot, it would be around $10, and with a micro lot, it would be around $1. So this is how we calculate profit and loss using pips and lot size. Now let's move to the most important topic, risk management. More important than any strategy is proper risk management, because no strategy in the market is 100% accurate. Every trader faces losses. The only difference is that professional traders know how to control those losses. The two most important parts of risk management are stop loss and target. Never trade gold without a stop loss. At the same time, always decide your risk percentage before entering a trade. You should never put your entire account at risk in a single trade. Professional traders usually risk only 1% or 2% of their total account on one trade. For example, if your account balance is $100, then ideally you should risk only $1 or $2 per trade. And when it comes to targets, you should try to maintain at least a 1 to 2 risk-reward ratio. Now let's talk about the best time to trade gold. The gold market remains open 24 hours a day from Monday to Friday, but the movement is not the same throughout the day. That's why understanding trading sessions is important. Forex and gold markets mainly move through 4 sessions: Sydney session, Tokyo session, London session, and New York session. The best sessions for gold trading are usually the London and New York sessions, especially when London and New York sessions overlap. Gold often shows very strong movement. During this time, both liquidity and volatility remain high. You can check the exact timings of these sessions on BabyPip's website. Now let's move to the last part of the video where we'll discuss a simple gold trading strategy. The strategy is very simple. First, switch your chart to a higher time frame, like the 1 hour or 4 hour chart, and identify the overall market trend, whether the market is bullish or bearish. After that, mark important support and resistance levels on the chart. Support is an area from where price repeatedly bounces upward, and resistance is an area from where price repeatedly gets rejected downward. Now switch to a smaller time frame, like 5 minutes or 15 minutes, and wait for rejection candles near those levels. For example, if a rejection candle forms near resistance, you can look for a sell entry and place your stop loss above that level. Similarly, if a rejection candle forms near support, you can look for a buy entry and place your stop loss below that level. Using this setup, achieving a 1 to 2 risk-reward ratio becomes much easier. And remember, never enter a trade without confirmation. Rejection candle confirmation is very important. So friends, gold trading is not difficult, but it is definitely risky. If you trade gold without knowledge and without proper risk management, then blowing your account is almost guaranteed. But if you trade with patience, discipline, and strong analysis, then the gold market can give you amazing opportunities. Always remember one thing in trading: the most important thing is not profit, it's survival. Because the trader who survives in the market is the one who becomes successful in the long run. If you found this video helpful, then make sure to like the video, subscribe to the channel, and comment below which topic you want to watch next. I'll see you in the next video. Thanks for watching.